brings up nicely from coal to the second bit of the debate, the environmental consequences or climate change. Given the lack of a material breakthrough at Durban last year to find a successor to the Kyoto Protocol, what sort of mechanisms do you think can be used to encourage clean energy adoption around the globe? And will we sort of see, which we are sort of seeing, more country by country type programs? Joseph, why don't you kick off on that one?
Right, so I think, going into Durban, I wouldn't say we were optimistic at all about a positive outcome. In fact, our CEO, Michael Liebrich, who is always a perpetual attendee at those conferences, actually opted out this year. Going into it, not optimistic, and I think what came out of it was what was expected. In terms of carbon markets playing an important part, obviously it will continue to play an important part in the EU and eventually in Australia as well. But in terms of I think in terms of the prospects for new carbon markets developing outside of those two places, it's probably not fantastic. I think that what's going to happen is that countries are going to take more of a country-by-country view, and in terms of the renewables portion of their portfolio, will instead of taxing or instead of imposing carbon markets on their fossil generation, will instead decide to set capacity targets for their renewables capacity. There's a ton of money that needs to be raised, a lot of capital expenditure. Depending on whose figures you're looking at, to hit that 450 parts per million target, it's on the order of $1 trillion a year by 2020 globally. There's been a lot of ideas. I think out of Durban there was the green carbon fund or climate fund idea that would be sort of funded by governments. I think that the likelihood of governments providing the bulk of this funding is pretty minimal, especially given the current economic climate. It's hard for governments to justify throwing money into these international climate pools when their constituents are suffering at home. What that's going to mean is that the private sector is going to have to step up to provide a lot of that funding. And if you think about the sources, we'll need traditional equity investors to provide a chunk of that. There is some demand out there. It's light at the moment to finance this kind of development. There's consortiums of investors, of institutional investors group on climate change being one of them, where investors are stepping up and saying that they are going to continue to look at climate change friendly investments in the context of their investment decisions. And then on the fixed income side, which a bulk of this financing for climate change will probably come from that side as well, I think we'll need to see a lot more involvement on the side of the development banks, who are already quite active in this space and lending to low carbon projects in the developing economy. In fact, there's quite a few of them that are financing bonds, that are using bond finance to provide funding already for those loans to provide for clean energy in the developing world. I think we'll see more of that, in addition to finance support from the export banks to help make investor appetite for bonds backed by clean energy investments a little more palatable by providing credit enhancements. So I think there's a whole series of packages. It's probably not going to be a centralized package. It comes out of Durban or Kyoto of any sort, but more of a piece-by-piece package on a country or sometimes bilateral level.
Do we think that carbon trading has been a failure given the price of carbon at the moment in the European ETS scheme? Anybody?
No, I don't think it's a failure. I think it's simply the low price is simply a reflection of the fact that we have a recession and there's no demand. So you have two choices. You reduce the amount of available certificates and artificially increase the price, which makes a lot of sense if you want to boost carbon profits, carbon targets. But of course, if you do that, once you have an economic recovery, you're making your recovery more expensive. And is that really something that's politically attractive? I think having praised the OFGEM so far, I thought maybe the UK has gone out on a limb with its own carbon tax.
Yes.
To say, if carbon prices are low, we're going to set our own floor and we'll charge the difference for tax, which I think is a very clever system because it's ostensibly popular to be green, and it also raises money. That's a double whammy for the government. And our original assumption was that would catch on very quickly across Europe as a means of effectively making money from a politically popular measure. I think the challenge is the way that the UK system is set is that the floor that they've set is so high that it makes the UK uncompetitive, and I'm not sure that Europe will follow. But I do think quite possibly what Europe will do is follow the mechanism principle, but at a much lower level. So you're going to have higher CO2 prices, and today you're going to have tax inflow for the European government, and that will in effect solve what you're asking, which is, yes, we're going to have CO2 prices which improve renewable parity, which is what everyone's after.
Stephanie, do you want to respond?
I didn't think I'd get out of not responding to that one. I think there's a couple of points that sit around this, and here as well draw the distinction between government and OFGEM as an independent regulator. I mean, we obviously contribute our views and expertise to government in terms of the reform package they're considering at the moment, particularly around EMR. And I think the point that was made earlier, which is worth highlighting, is it really is a question of diversity and the package of a number of incentives and mechanisms across the board that will generate a number of potential scenarios or future for, if you like, green outcomes and carbon outcomes. And across that blend, there are different challenges depending on which types of mechanisms and schemes you're looking at. I think it's quite a big challenge to work through. We're certainly cognizant that there is no one solution, and that the interdependencies between all the initiatives or potential initiatives and schemes and incentives needs to be balanced off against what is actually going on at the moment globally in the economic landscape. So there's a lot of analysis being done to consider where the future is heading, and in taking decisions going forward, we need to be cognizant of how the markets might move going forward. So it's not a straight answer, I don't think, but I think certainly something we're looking at.
And Julio, from a supply side view.
Personally, I think I'm a bit skeptical of multilateral agreements in terms of reducing carbon emissions. But then I think that most of the effort is going to be done either on an individual country level or even individual companies that are going to drive their emissions level down as they go along. Probably the concept of clean energy is a bit fuzzy as well. Like you can regard it as being different things. Even coal could be clean as long as you have like a carbon capture and storage, and then you get rid of all the CO2 emissions that it generates. CCS is still not there yet, so technology is still. There are different players piloting different technologies and seeing what works, what doesn't work. Cost is still an issue. And I think that there is going to be a lot of development on that field going forward, but then we're not there yet. And from Statoil side, from the supply side, I think I don't need to be a one-word panelist, but then going back to the technology point, I think this is what's going to drive a lot of the reduction in carbon emissions going forward. So just to quote or just mention one our experience that we have, even though oil sands are not very popular in the European Union or much less in Norway, we've taken the challenge of investing in the oil sands project in Canada because we believe that we can, applying technology, reduce the amount of emissions that we can have out of our project and have a more efficient way of producing oil sands than most projects, or at least. And it's not open pit mine; is a steam assisted extraction of oil sands. But we've been putting a lot of effort into driving down the emissions of this project, so we could become one of the most efficient operators in that field. That's still going on. We're piloting a few alternatives, but that's how we see that's a much more productive way to engage into this discussion and this effort, rather than just staying outside and then just criticizing from a distance. So that's how I see the other companies and other countries also behaving to drive emissions down going forward.
And just on carbon capture, what are the sort of key drivers that will make it become a reality? I mean, here in the UK, we recently had the collapse of the programme where they'd offered £1 billion, and that collapsed. So I just wondered, when will we see that become a reality, and what will be needed for that to happen?
I think that probably the easiest answer is when costs comes down to something that makes the overall project economics reasonable, and that's not the case yet.
So we're talking government subsidies again, or?
I think even in the the wider landscape of how you apply government subsidies in renewables generally, government subsidy alone is not enough to get over the technology curve, particularly when you're looking, I mean, CCS is further behind the curve, I would say, than offshore wind. And offshore wind is still very much in the early stages. If you look at your bell curve, we are really on the climbing up the hill on the bell curve in wind. And it's not to be underestimated what that does to the evolution of the market, and I suspect subsidy alone will not be enough in any sort of to overcome that. Not to say you rule it out, but I think there's a lot more that needs to happen in the CCS technology space.
I think that there's an interesting interplay there between carbon markets and CCS as well. I think there was a lot of excitement about CCS in, say, about 5 years ago, 6 years ago, when there was prospects of a U.S. carbon market. A carbon price in the U.S. combined with the carbon price in the EU might have helped bring those costs down. And if you couple those carbon prices with some government subsidies and some public-private partnerships, things start to be a little more viable. But in absence of that market mechanism, the economics definitely suffer.
Could I just comment on climate change? Take a little bit a step back. I think it's important that the world recognizes that it's going to be really hard to reconcile significant CO2 emissions with population and GDP growth. And I mean, if you do just simple math and you take the famous Kaya identity, which equates CO2 emissions with population times wealth, GDP per capita, times carbon intensity, CO2 per unit of GDP, and you say that, okay, consistently with keeping the temperature rise up to a maximum of 2 degrees, that means that CO2 emissions should go down by half until 2050. In the meantime, the population will go to 9 billion people. Wealth, if you assume that it will grow at 2 to 3% a year for the next 30 years, it means that GDP will multiply by 3. And if you take these 3 variables and then you get CO2 intensity, it should go down by 1/10. It should be 90% less in 2050 than what it is today in just 40 years. It's something that we've never seen in history, and gives us like outrageous things like a nuclear station should be online every week for the next 40 years and crazy things like that. So I think we should start accepting the hard reality that it's going to be really hard to meet this 50% CO2 reduction by 2050. And I think there are basically three takeaways from this. The first one is that I think we should strike a better balance between the investments we do on adaptation versus mitigation. What we've been talking here is only about mitigation, and I think just the notion that we shouldn't throw the towel to the floor and keep avoiding the problem. I think we should put more emphasis on adaptation investments. The other takeaway for me is that perhaps we should start really rethinking about this UN-led process of yearly conferences that do not produce any end results one after the other, and perhaps we should go to a more bottom-up approach of regional initiatives, regional markets, and then try to work out something global, but not try to start by imposing a global deal that so far has proven elusive. And then perhaps the third conclusion, and going back to the European emissions trading scheme, how is that a failure or not? I think Europe currently is like in the middle of a bridge. The CO2 price is around €8 per ton, so it's a very weak signal. It's still a drag on the economy, even though not a significant one, but it doesn't even provide environmental benefits because it doesn't even incentivize the coal to gas switch. So it's a bit a nonsense position. I think Europe cannot go backwards, which would mean eliminating, scrapping the ETS, saying CO2 price will be zero, because I mean politically that would be losing face on a very important point, and also leaving Europe with a lot of stranded assets. So what I think is inevitable is that Europe takes a step forward, goes to the other side of the bridge, and reinforces the carbon price, either by setting aside licenses or by putting some kind of floor for the CO2, so that at least you are consistent with your objective of decarbonizing the society. So going back to the very first point, I think it will not happen as fast as people hope, but inevitably decarbonization will happen. And it would be, to my mind, really a failure if we either stay put where we are or if we go back to the other side of the bridge.
And just on that point, I mean, one of the big tensions at the moment seems to be between gas versus renewables. How do you see that playing out? I mean, do you think we should be wary of a dash for gas at the expense of renewables, or investing in renewables, or where do you sort of see that going? Can they coexist, I guess?
Yes, clearly I think they will have to coexist, and again, gas is the best technology to provide flexibility to the system and to back up renewables. I think, I mean, we can have now, given the current recessionary environment, a bit of a freeze or break on renewables take up, but I think it's not a fad, it's not a fashion, a green fashion that happened in the last decade, and we'll completely forget it. It will go on, perhaps at a slower pace, but clearly renewables, gas as backup, and then grids for me is in a way the three components of the future energy mix.
Anybody else want to jump in before we move to the next section?
I mean, I would just add 2 comments to that. I think this really does come down to a question of diversity in energy mix. And in every energy category, you have different challenges about the backbone of infrastructure that needs to be provided to support that, and they're not uniform. So I think that's the challenge from a market evolution and from a government point of view, a policy, and from a regulatory point of view, a control point of view, how we do that, recognising the contemporary challenges that sit there, because it's a different space to where it was last time there was a dash for gas. I think the second point, just sort of tying it back to the question of incentives across the board, there's a balance, and the interesting thing I think at the moment is, through EMR we're obviously looking at the question of, we're looking at ROs and CFDs are being looked at, so contracts for difference as a mechanism for incentivising the renewable market going forward. I think the recognition is renewables has moved on from when ROs were first in place, and a number of other mechanisms have now been introduced to try and create certainty in the delivery of infrastructure, and the need to tailor and evolve the structures that support that energy mix is going to continue. 3 years ago, we didn't have a regulatory framework that supported offshore transmission being rolled out the way it's now being rolled out. There wasn't a need to develop something like that 10 years ago. But ROs have played a role in incentivising that market. The market is now mobilising because there's a commercial pipeline. I think it's recognised that if renewables is going to continue, it needs to comfortably sit in that framework.
Yeah, just one last comment on that discussion, renewables versus gas, which is a point that from our side doesn't make sense to pit one against the other. I think as Maurice was showing on his charts, the call for additional supply of all different energy sources is going to continue over time. So you will need both more renewables and both more gas to be able to supply the growing energy needs. And they have different development paths, and the gas market is maybe more complex than the renewables one, in the sense that you now have a standalone market in North America that is probably going to reconnect to the market through exporting LNG cargoes. And then you have Europe competing against Asia for the same LNG cargo and keeping the prices high in both regions. But the point is that you need both. You need both renewables, and the problem with renewables from our point of view is how to scale them to actually meet demand. How do you scale a wind farm if you need twice as much power from that same wind farm? How do you actually scale that in a way that is sustainable over time? So you can't just pit one fuel source against the other, because you will need both going forward.
And that moves on actually us to the next section, which is on infrastructure. Given the existing infrastructure that we have is sort of based very much on fossil fuels, where do we see infrastructure going, at least in the UK, for offshore wind? Super grids are a big thing that people do talk about, although I probably don't even know what they really are. I don't know, Philip, if you want to talk about where you see your clients, what they think of the infrastructure.
They will continue to invest if they can have visibility on an appropriate return. It's a simplistic statement, but I think the problem at the moment is that in many areas, you currently don't have sufficient visibility as to the return you're going to make. You don't have it for a CCGT at the moment. CCGTs in Germany are hardly running at all. CCGTs in Spain are hardly running at all. Everyone who's built one the last couple of years is regretting it because they're not being used, they're not needed. So are you likely to build another CCGT? Well, certainly not in the near term. But that's not because they don't like CCGTs or don't think that the technology is the future. They do, but at the moment there just isn't the demand. So I think we, and Pedro said this earlier, there's going to be a hiatus in terms of investment in a number of things, but not just in renewables, a hiatus in any kind of generation capacity in Europe, unless if you put in place some kind of fixed tariff, which means that regardless of demand, regardless of need, you will build it because you can make a return if you believe in the tariff. Which is where the next challenge comes in, which of course is that in Southern Europe you have tariffs that are constantly being revisited and reviewed. So far the wind tariffs have historically not been touched retroactively, only looking forward. So yes, there's not going to be any new build for some time because the tariffs have been cut. But the solar tariffs have been cut retroactively, and that's a huge political risk. Now, why was solar cut and not wind? Frankly, because the solar developers are all small people, and the wind generators are all people with a lot more capacity and a lot more influence, I think. So it was an easier target to cut. Do I think that we're going to have retroactive tariff cuts across Europe? I don't really think so. But there just isn't a stability of the outlook to ensure large investments. So slow go investments, there isn't the need now anyway, so it's not the end of the world. Most of the capex spend is going to go only to that that's essential. I think grid investments will continue to go strongly, but they're regulated, so why not? And the rest will go outside of Europe.
I mean, there's probably a piece to play in this which plays back to an earlier point that Philip made, is looking at the landscape across Europe and understanding structurally what that means. So the question of capacity in different markets across Europe, there's discussion and debate that has arisen out of the supergrid debates around interconnectors. We ourselves are looking at the question of interconnector policy going forward. Overcapacity in Spain in solar, excess capacity from a generation point of view somewhere in Germany. There are real questions going forward about how that can play into a more sort of harmonised European landscape. I think the supergrid space, which is, there's a multi-European forum with various parties, including ourselves, involved at the moment, looking at the questions around the North Sea grid in particular. We ourselves in my team did two pieces of work at the back end of last year with Redpoint and TNEI, looking at technically what is actually possible from an interconnection, I mean a grid system, where you've got mixed generation out in the middle of the ocean and you've got cables coming in that will also evacuate power between different jurisdictions. The technology in that space is really still at the beginning of the curve. It's not to say it's not possible, but there's a recognition if you're going to invest in that type of backbone in Europe to create opportunities across the market, you really need to look at it from a regulatory point of view. The amount of capex involved is massive, and technically, despite what you may hear about HVDC, there are some challenges around different parts of the kit required to make interconnection and mesh networks operate. Not to say it's not possible, but there's some serious policy investment work and commercial development work that needs to happen in that space. The good thing is it's happening, so I think there are opportunities going forward, and when those pieces can be cracked, I suspect, you're looking at a different profile for capacity across Europe, maybe.
How big is the issue of maintaining? I mean, if you talked about delivering offshore wind regulation at OFGEM. I just wonder how big an issue is maintaining the sort of infrastructure that you have for renewables offshore, given that they're sort of based in quite corrosive conditions.
Well, actually, there is history of subsea infrastructure that comes out of oil and gas. There's history of it in the telco industry. I mean, most of the world is connected via internet because of big subsea cables. So it's not a new market in terms of risk. It's just at the scale we are talking about developing to support something like offshore wind or interconnection all over Europe. It's a quantum of rollout that's never been seen anywhere before. So the technology challenges that go with that are different. Straight point-to-point interconnection is less of an issue. When you start doing interconnection in subsea environments and you start plugging generation in that interconnected space, it does test the current technology envelope. So I think from a regulatory point of view, if I look at what we've been doing in offshore transmission, which is running competitions for grid infrastructure that sits under the sea, offering revenue streams on a regulated return basis for 20 years, we're pretty comfortable that the risk can be managed, and there are parties coming forward with capital and operating partners who say they can do it. The first projects we've dealt with through that process are pretty much point to point. There's a bit of phasing. Projects like London Array get a little bit more complex. Going forward, we know that there's going to be greater interconnection, redundancy, resilience built into those offshore environments. I think there's a lot of learning that will come out of that mean the sorts of scenarios that are being talked about here from a Europe-wide point of view will be possible. Different jurisdictions may look at what we've done in terms of providing regulatory certainty. The good thing is we're getting signals from market that this gives suppliers, from an R&D point of view, some certainty. There's a reason to invest your money in looking at these questions. And that framework could be useful when you're talking about other types of pipes and wires infrastructure that needs a long-term commitment. The undersea environment of itself isn't a big problem. The question is who gets remunerated in what way to manage the risk.
And just from an oil and gas perspective, then you can have some surprise down the road. Some of the offshore platforms in the North Sea have been built up to last for 20, 25 years. And some of them have been going on for 40 years, and now they're producing more than they were designed to, and they're more efficient than they were before. So, and installing a wind turbine to last for 20 years, and in 10 or 15 or 20 years time, we don't know exactly, but we might have access to better technology and keep it alive from those turbines going on for much longer than that.
All right, okay. I think we should move on to the next bit of the panel debate, which is regulation. I guess we have already touched on regulation in Europe and the carbon floor price here in the UK. Joseph, if I could maybe ask you, we have seen grid parity for renewables in some countries in Europe recently. I just wondered, what is your forecast for renewables? How long do you think they will need to be backed by subsidies?
Right. We have a fairly specific target that we think that by 2020, Northern Europe renewables, so we're talking onshore wind and utility scale solar right now, will be at parity. We did see earlier this year that onshore wind in certain German baseload scenarios did hit parity. That subsequently changed as power prices went back up again. That's sort of been the story recently, is that there's periods where we're touching on parity and periods where we're not. And a lot of this has to do with siting. I think that as a result of potentially overzealous policy about feed-in tariffs, there were probably a lot of plants that were built in places that, in absence of subsidies, even with cheaper technology, probably wouldn't be economical. Putting in a PV plant in North Germany where you have like an 8% capacity factor, that's a tough idea, even if your technology is pretty cheap. So 2020 in Northern Europe, and then we see that offshore prices are actually have been increasing in our experience over the last couple of years. I think most of that has to do with the fact that we're still sort of studying the deployment that's going on. There was a huge amount of financing last year, record year, and we're looking for record installs this year. So we look to offshore and to certain solar thermal, like solar thermal with parabolic, to be sort of like the next technologies to approach parity. And then, of course, there's biomass technologies, which are already at parity, some of them. So incineration, for example, depending on how much your costs are, can reach parity. And interesting enough, a lot of the natural gas plants, and even Drax in the UK, I believe, is retrofitting some of their boilers to be able to co-fire biomass. So there's a lot of optimism in that area as well.
And what's the sort of the panel's view on the regulation if we take Southern Europe, the way they've sort of flip-flopped over subsidies in the recent 12 months, with quite a big impact on the industry?
Yeah,
Is it teething problems as governments also try and figure out what the right type of regulation is?
I mean, I think there are growing signs, not only through the hesitation on feed-in tariffs and some retroactive cuts and so on, that Europe cries for a thorough market design reform. And I think the background to this is that, one common thing of all low-carbon technologies is that they are high capex intensive and low or no OPEX. They have almost no OPEX. And what this means is that the current environment that we have of competitive markets based on an hourly pool price is simply not fit for purpose to attract capital to this kind of technology. So I agree that the most mature technologies, wind and hydro, wind onshore and hydro, are already competitive, so they should progressively have phased out their subsidies. And the question is, okay, so let's simply put them in the market. Now, because they are completely capex intensive, if, for example, the oil price goes back to, I don't know, $20 per barrel, and so the pool price, the brown power price goes down to 20 euros per megawatt hour, there is simply nothing that installed wind turbines can do to react to that. It's a sunk cost, it's a sunk investment. So the market price for me is not the instrument to deal with this. And in that sense, I think the UK's electricity market reform is a very, very important step forward in this, because it focuses the competitive element that we have to keep, not to go to a centralized planning system again. We have to keep a competitive element, but not based on an hourly price, but focus the competitive pressure on the moment where the investment is done. So that's where promoters have to be innovative to come up with solutions with the lowest cost solution, and that's where you have to also make sure that you lower the capital cost as much as you can, because that's the competitive source, the source of competitiveness of capex intensive technologies. And so an important way to provide this, to put the pressure at the investment moment and lower the capital costs, is by longer term contracting. And in that sense, for me, the contract for differences is a very elegant instrument, because it keeps both a short-term optimization signal from the spot market, but provides certainty and insulates promoters from long-term price risk. And especially in the moment where, McKinsey published a paper called Farewell to Cheap Capital. I mean, the world is going to increase their investment, both the West and the emerging economies, and the emerging economies are going to reduce their savings share as they grow into a more consumption-driven economy. So the cost of capital will go up, and so what you have to do is lower the premium, the risk premium that on top you would put on this. So long-term contracting, which has all to do with market reform, for me is absolutely key.
Right, okay. Anybody kind of jump in on this? I mean, it sort of seems like we're going towards more a sort of state control of the energy markets, possibly back to Stephanie. No, you don't agree?
Well, I think, I'm very comfortable with what Pedro has just outlined. I think there is a recognition of the role that competition needs to play, and it's understanding where in the landscape it plays that to greatest effect and greatest benefit. So, and I guess that's part of what EMR is going to consider. And I know everyone's looking forward to seeing what comes out of that process with government, but I don't think we're certainly in a place where competition is out of that space.
No, but I do think that more government intervention is a good thing.
Good thing.
Yeah. I think that the experiment, or long-running experiment, in completely liberalized markets, also back to your question of will the utilities invest, where my answer is if they get the right return with a predictable outlook. And the question is, there are some forms and situations where a pure market mechanism is fine, but in the current environment I think you need more visibility, and that means more government intervention. I do think that it's just been very hard to get the right type of intervention, the right structure. For example, if you look at most of the markets where they've used a tariff mechanism, unlike the UK, on the one hand, I said earlier, a tariff mechanism is good because there's lower risk. That means a lower cost of capital, and therefore, theoretically, you get a cheaper delivery of your renewables. Whereas the UK has always said we're going to have a market mechanism because market discipline means I get the cheapest cost. I actually think in the current environment, probably the set tariffs is smarter because the capital otherwise doesn't become available. So yes, let's go to more fixed tariffs, but not in the way that the rest of Europe has done it, because I think the way that the rest of Europe has done it has not been very clever, because what you do is you set a tariff level for a country and say, if you build a wind farm, you get this tariff. What that means is you have to set the tariff high enough to make the least attractive wind farm location feasible. That means you get 80% of your wind farms are over-subsidized and 20% are at the cusp of what's sensible. And so in that sense, I think a US system whereby you have an obligation for utilities to buy renewable power, they go and auction PPAs. The PPAs are always competitively tendered. That means you have no wastage of over-subsidizing wind farms in great locations. That's a much more sensible system.
Agree.
And then to the last bit of the discussion, which is on financing. I mean, in the UK, there always seems to be a lot of focus on the big six utilities, and the implication almost seems to be that they're the ones that are going to have to pay for the £200 billion over the next few decades to renew the energy infrastructure. But obviously, that will include pension funds and infrastructure funds. And I just wondered, I mean, maybe Joseph, what your sense is when you talk to these companies or these investors, how willing are they to invest? Is there money there to deploy? I mean, again, are the returns right? I guess is what they would be looking for.
Yeah, there's a lot of interesting things. I mean, if we even take a step back from renewables and just look at what's likely to happen in the project finance space, infrastructure finance space over the next decade, Basel III is looming. And the European Union banks are going to be increasingly pushed by that. That has significant implications for project finance for a couple of reasons. Long-term lending is probably going to get reined in, and the rates at which you're able to borrow short-term, so revolver facilities, those are probably going to spike. So there's going to be a shift in the way that the fixed income portion of infrastructure finance obtains its finance, probably more so in Europe than anywhere else. What might happen is that there may be an increase in capital market solutions. So bonds being issued to the market on the backs of renewable energy projects. We just recently saw that in the U.S. There was a $700 million issuance on the back of it was pushed up to $850 million on the back of the Topaz PV project. And the appetite was there. Investors are, I think, by and large, still not quite comfortable taking on the sorts of risks inherent in clean energy. And I think a lot of that has to do with education. And I think we'll just sort of see that increase over time. And then on the equity side, we're seeing a lot more interest from the pension funds and the large institutional investors like insurance companies who are actually buying direct stakes in projects, sometimes in different formats, not typically during the construction phase. But I think over time you'll see that investors will get a little more comfortable directly investing, and the share of bank finance commercial bank finance may actually decrease.
Mm-hmm. I mean, I would just, I'd agree with that just based on what we've seen come out through the offshore transmission competition process we've run. The interesting thing, I think, education can't be underestimated in this sector, because when you're talking about 300 billion pounds worth of capital investment that might be required across various parts of the system, that's got to come from somewhere, and the regulated utility market perhaps isn't as familiar with the project finance models. Some individuals are, depends on background and pedigree, and therefore that reflects in organisational comfort. I know certainly when I came into this space from a project finance background, talking to banks 3 years ago before we launched the OFTO regime, and in fact talking to equity, the education that's gone on in just the last 3 years to understand the offshore transmission space and the bits that can relate to that, like grid system or generation capacity, the vernacular and understanding both in the credit markets and amongst banks has moved on a lot, and I think that has a big impact on the way in which the financing landscape plays out. What moves from being perceived risk to actual risk is informed by the education process. Not to say that will solve everything, but it's not to be underestimated, I think.
And just Philip, from a banker's perspective, the Citigroup.
I think Joseph makes a very good point, which is the Basel III is coming around the corner. Not to mention the fact that half the European banks are struggling to make it to the next year. So balance sheets are being reduced aggressively. That means new lending is hard to come by. That means only the best projects or the best companies can borrow. Brings us back again to, if you want to have banks lend to those projects, you probably need to have visibility of the tariffs. But more importantly, once you have visibility of tariffs, your assets become much more financeable in the bond markets. And I do agree that with the state of the bank markets, which is in dire health, shall we say, other than the American banks, who are now at the moment in great health because they had their sort of bigger problems in recent history. You're going to need the bond markets to finance all of this. That means tariffs, and those tariffs are coming. So I think we're in good shape, but it's going to mean a different source of financing, which is bonds.
All right, thank you. And I think we need to move on to questions now. So if anybody has a question.
Is Statoil considering and looking into using renewable energy to help with existing operations, as it's actually one form of energy that it's one industry where renewable energy actually makes financial sense. And in terms of offshore wind, from a financial perspective, what do you see as the importance of integrating and exploiting the existing infrastructure in the future?
We definitely already do that there are some pilots in Norway about electrifying some offshore platforms and tying them back to the grid in Norway, which is powered by hydroelectric power source. For the rest of renewables, there are some, I've heard about all sorts of pilots that can be done, like using some of the gas produced in an unconventional gas place to reinject that gas and use it for fracking, or reinject some of the gas produced or some of the CO2 produced and keep the pressure up on offshore reservoirs. Integrating renewables with our current operations is just a matter of how do you want to use the energy source to produce out of those renewables, and then which renewables, and we can discuss over here what exactly you mean by that. There is a broad range of things that we could do. The way that I see it is just a matter of using an energy source that is a clean energy source to reapply it in the current production operations. Regarding the wind, our wind farm investments, the way that we see it, it's a part of our portfolio to expand our energy production, and it fits well with our capabilities as an offshore operators. And that's as far as it goes. It's an important energy source, and it fits well with our core skills. So we can be very competitive doing that. How much and where and so on. I think that the thinking goes that we would like to have more of offshore wind turbine investments, but so far those are mainly concentrated in Europe, and we don't have any plans to go elsewhere yet. I think there's still a learning curve, there's still some development phase, and we are seeing what works and what doesn't work as we go along.
If I could just add something to that, I think through the competitive process we're running, and my team also set capex limits, if you like, on some of the wind farm developments that are going on at the moment. Well, not the wind farm, the transmission part of the wind farm. So that can often include the offshore platforms. So we spend a lot of time assessing the detail of how these projects work contractually. And then we have bidding coming in through our process to propose operational solutions. Probably the first area that I would see across the industry where the synergy is most likely is definitely in the services part. In theory, there's spaces around the communications and monitoring piece that could evolve over time, but the way the signalling and monitoring occurs in electricity transmission versus gas is completely different. But the knowledge bases have the potential to evolve over time.
Okay, so regarding energy efficiency, how do you see that, for example, utilities will have incentives to address that issue of energy efficiency, given that without it, the carbon, the CO2 emissions of vehicles are almost impossible? And from a regulator standpoint, what incentives need to be there for utilities to actually have an incentive to reduce their sales?
I mean, this intrinsic conflict of why should a company promote reducing its sales? I mean, I think it has always been there, but I think it's behind our back now, because it's a question of, do we really believe that if we don't do nothing, expecting that consumption will keep going up, do we really think that that will happen? So the business as usual scenario where demand grows continually, will that really ever materialize? And the answer is no, because many technologies to reduce demand and more efficient consumption are already in the money. And so that will happen naturally. So it's simply a question of whether do you want to be in this field and take the most out of it or not. The scenario in which nothing happens and consumption grows at unsustainable growth rates, I think doesn't exist. So that's the way personally I see that this conflict simply disappears. What needs to happen so that this market develops? Again, I think that many of these technologies are already in the money. I think there's basically two problems. One is liquidity problems, because some of these technologies are, again, capex intensive, and clients don't have liquidity to invest either in a CHP plant, or even if we think at a very distributed level in households, you have to deploy capex insulating your home to reduce gas consumption. If you do the math, it's a good investment, but you have all the hassle of going through that, and you have to spend capex upfront. And if you're liquidity constrained, then that's a big problem, which gets us again to the financing issue. The other thing is simply setting up the regulatory framework so that companies can work within this space. I mean, it's contractually a big challenge to go ahead with this, because energy efficiency implies that to calculate how much you saved, you have to estimate what you would have consumed if you didn't have this technology deployed, which is contractually and even technologically not easy to do. And so there's a lot of protocols that have to be set up and regulatory environment that has to be defined so that this market develops.